Black Tuesday in 1929, Irving Fisher, America's most respected economist, declared that stock prices had reached what looks like a permanently high plateau. Fisher wasn't just wrong, he was catastrophically wrong. Within days, the market would lose 89% of its value, wiping out fortunes that had taken generations to build. But here's what's truly chilling. Fisher wasn't lying or being reckless. He genuinely believed what he was saying. And that belief, that absolute certainty in the face of mounting evidence, is exactly what makes market crashes so predictable and so devastating. You see, crashes don't happen when everyone's scared. They happen when everyone's sure they can't happen. And right now, that same deadly cocktail of overconfidence and willful blindness is brewing again. The only question is whether you'll be prepared, whether you'll be another victim wondering how you didn't see it coming. The most terrifying thing about market crashes isn't how fast they happen, it's how predictable they are. Look back at the last century, 1929, the 1973 oil crisis, Japan's lost decades, the dot-com bust, the 2008 meltdown. Different headlines, same playbook. Step 1 is always leverage. In 1928, ordinary Americans borrowed heavily on margin to buy stocks they couldn't really afford, convinced prices only went up. Sound familiar? Today, margin debt is near record levels again. People are tapping home equity, raiding retirement accounts, and even using credit cards to chase market returns. That borrowed money multiplies profits on the way up and multiplies losses on the way down. There are specific, measurable forms of collective madness that show up like clockwork before every crash. In 1999, anyone who dared ask whether Pets.com should be worth more than established Fortune 500 companies was mocked as a dinosaur. In 2006, predicting nationwide home price declines was treated as financial heresy. Today, if you question whether some AI stocks deserve 200 times earnings, you get branded a Luddite who doesn't get the future. The names change, the certainty doesn't. The second sign is the democratization of speculation. Bubbles end when investing becomes a social sport, not a discipline. In the 1920s, shoeshine boys were trading stock. In the late 1990s, day trading went mainstream. In 2021, meme stocks turned investing into a casino where fundamentals barely mattered, and diamond hands became wisdom. Now teachers, nurses, and college students are pouring savings into options and crypto, often guided by TikTok clips and Reddit threads, instead of long-term financial education. The third warning sign is risk getting rebranded as safety. Before every crash, Wall Street invents ways to make dangerous bets look conservative. In the 1920s, it was buying on margin with just 10% down. In the 1980s, junk bonds were dressed up as high-yield security. In 2008, subprime mortgages were sliced, diced, and stamped ALA. Today, we see SPACs, NFTs, and DeFi yield farming marketed as alternative investments or diversification strategies. But many are just faster routes to big losses. Meanwhile, smart money quietly acts differently from the crowd. When retail piled into tech in early 2000, insiders were selling at record rate. When buyers stretched for McMansions in 2006, hedge funds like Michael Burry were quietly betting against housing. And right now, while headlines cheer new market highs, insider selling is at levels similar to past peaks. Executives cashing out of their own companies is a warning sign, and one anyone paying attention should find alarming. The fourth pattern is the chorus that this time is different. Every bubble generation points to some new era that supposedly invalidates old rules. In the 1920s, it was radio and cars. In the 1960s, it was the Nifty 50, buy at any price stock. In the late 1990s, it was the internet, which made profits look optional. In the 2000s, it was the belief real estate could never fall nationwide. Now the narrative is AI EVS, and the idea that massive government spending and endless money printing solve everything. Innovations do change the world, but they don't change arithmetic or human psychology. Paying $100 for $10 of real value ends the same way, regardless of the sales pitch. How does this cycle usually end? Quietly, then ruthlessly. Crashes aren't created by the headline event. The headline just exposes the structural rot. Black Tuesday didn't create 1929. Years of speculation and leverage did. Lehman didn't carve the 2008 crisis out of nothing. It was the first visible domino in a system built on sand. What makes today especially dangerous is that many warning signs are flashing at once. Corporate debt as a share of GDP is higher than in 2008. Retail speculation in some corners has outpaced the 1990s. Valuations across stocks, bonds, and real estate are stretched. Central banks have boxed themselves in. raise rates and risk tipping the economy into recession, or cut and fuel even more speculative excess. This bubble is broad. It's in technology stocks trading at stratospheric multiples. It's in housing markets where an average home can cost more than an entire profitable business. It's in bonds where investors sometimes accept negative real yields, effectively paying governments to borrow. It's in commodities where speculation can push prices away from supply and demand reality. When everything is overpriced, there's nowhere obvious to hide. The trigger can come from anywhere. A geopolitical shock that breaks supply chain, an unexpected inflation surge that forces central banks into a terrible choice, a corporate scandal that exposes widespread accounting tricks, a major technological failure that reveals system fragility, or simply the collective judgment that AI and EV narratives don't justify decades of perfect execution and unlimited growth. Any one of those can flip confidence into panic. When that flip happens, the unwind is fast and merciless. Over-leveraged investors get margin called and must sell. Algorithmic trading amplifies every downtick. Companies that seem bulletproof show rotten balance sheets. Millions of people can wake up to find retirement accounts, home equity, and college funds dramatically smaller, sometimes overnight. But here's the secret that separates survivors from victims. Preparation isn't about predicting the exact day of the crash. It's about how you position yourself so you can benefit when prices become reasonable. The biggest fortunes in history often grew during the fallout, not the boom. John D. Rockefeller famously said he made more money during the Great Depression than at any other time. Not because he predicted every twist, but because he had capital and bought when others were forced to sell. The math is brutal and simple. Lose 50% and you need a 100% gain just to get even. Avoiding that loss and having capital ready during panic gives you the chance to build generational wealth while others scramble to recover. Cash isn't a passive choice. Cash is ammunition. That doesn't mean you should sell everything and hide under a mattress. It means being honest about risk in a market that has forgotten what risk means. It means diversifying into assets that hold value even when sentiment collapses. It means cutting leverage and building liquidity while credit is still available. It means investing in skills and education that retain value even if paper wealth falls. And crucially, it means preparing mentally for a world where rules that seem permanent turn out to be temporary.